For example, suppose a share is trading at 1,000 rupees in the cash market, and at the same time, price of the same share in the futures market is 1,025. Then this 25 rupees is the arbitrage spread. Fund manager will buy the same security at 1,000 rupees in the cash market, and then at the same time sell the same security in the derivative, that is the futures market, at 1,025 rupees. 25 rupees difference is the gain for the arbitrage fund. As per rule, almost 65% to 90% of the money is always parked in this opportunity, and the balance is kept as margin money as per the compliance rules. So since it is investing and using equity as an option, it is a very tax efficient manner to invest your money for short term. Here, your short term taxation will be equivalent to 15% flat, and your long term taxation will be equivalent to 10% post first 1 lakh, which is absolutely tax free. As compared to liquid funds are obviously taxed at your slab rates. So as we started, arbitrage fund is a very tax efficient alternative of liquid funds.
All right, interesting. And I'm glad you brought up that comparison with liquid funds, because a lot of investors have been a little disheartened with what liquid funds have been doing up until very recently. The returns were just, well, not there, and we've always learned, as a prudent personal finance practice, that instead of keeping your money in a savings account, or your emergency fund in a savings account, or even if you're doing an STB, put it, in a liquid fund. So if you had to compare the two in terms of the risk factor, the role they play in a portfolio, how would you do that?
See, liquid fund is a pure debt product. They invest in debt papers or bonds which are maturing in next 90 days. When choosing a liquid fund, your return calculation should be roughly equivalent to the YTM, that is the yield to maturity, which that particular fund has, minus the expense ratio. Last important point about liquid fund is they are taxed just like your debt funds. And I am assuming since you are using liquid funds, your time horizon is less than 3 years. That is why you will be taxed at short-term taxation, which is equivalent to your tax slab rate. Versus when we talk about arbitrage fund returns is equivalent to the spread which is available during that month. Just for example, this month there was a spread of around 35 to 36 bips. Last month, it was a spread somewhere ranging between 36 to 37 bips. So that is the return which arbitrage fund will deliver. Biggest advantage of arbitrage fund is that they are taxed just like equity. That is, it is a tax efficient manner of investing. If we conclude this point, I think for corporate investors and for investors who are getting taxed at higher tax slab, obviously arbitrage is a good option. It is an alternative for liquid funds. And it is a better alternative of liquid funds when the YTMs of liquid fund are very low, as we can see right now. But if you are taxed at a lower rate and you are a retail investor, taxation is not an issue for you. I feel in longer term, liquid fund has its space because of its simplicity. So you have to choose whether you are there in highest tax slab rate or you are not. If you are not, you can easily stick with liquid funds. They are having some low returns right now, but because of its simplicity, liquid fund also has its space.
Okay, so I think largely from what you're saying, Anant, is your tax profile has a big role to play in choose, and of course time horizon goes without saying, has a big role to play in choosing liquid and arbitrage funds. Let's understand the market setup as well, because that too would have a bearing. You mentioned YTMs etc., which are low right now, which is the reason why liquid funds are the returns from that are a little muted. But as we know, and as you as well mentioned, arbitrage of course does have a good equity component. In fact, it's taxed as well like an equity scheme. So if that's the case, essentially, how would you look at arbitrage funds as a category, and how it essentially fits into your portfolio? Because we have the equity portion in arbitrage fund. It's almost 65%, and what you've said is that it's almost like hedging that equity portion. So wouldn't it also mean that the risk in an arbitrage fund is very low, and because you're hedging it, the return as well is virtually guaranteed?
Yes, you're absolutely right. See, in arbitrage fund, what we are doing is we are buying and selling security at the same time. So there is virtually no risk of market volatility in arbitrage fund. That is why we are able to compare it with the liquid fund, and we are thinking to use it as an alternative of liquid funds. See, liquid fund as a category is a very safe category. And if we are comparing liquid fund category to some other category, that category has to be top notch in safety point. But at the same time, we have to always remember one point, that arbitrage fund is not an alternative for your long-term debt allocation. It is best suited if your time horizon is somewhere ranging from 4 to 5 months to maximum 1 year. And next question can be, why am I asking for 4 months? I feel that because at times arbitrage margins can expand between two expiries, and there can be some short-term volatilities for a very short-term time horizon. So if you have time horizon of around 4-5 months to maximum 1 year, and you want something which is tax efficient alternative of liquid fund, arbitrage fund is a very safe category. There is no equity market volatility risk. Arbitrage fund is not at all dependent on market direction. So it is a very safe alternative of liquid fund which we can use.
Would volatility in the equity market be a friend of arbitrage funds? Would it sort of make the environment more conducive for arbitrage fund managers to exploit opportunities and thus provide a better profit for unit holders?
Absolutely, yes. And especially when volatility is on the positive side, in futures market, we can see that there is some extra bips or some extra margin which we can get, because the investor is ready to pay that extra margin because he's expecting some big moves in the market. So if we have some volatility, it is obviously better for arbitrage fund. Secondly, if volatility is on the upside, that is on the positive side, it is even more better for the arbitrage fund to perform, because they can get higher bips or higher margin.
So Anant, right now, what are you advising your your clients, your viewers? Considering the fact that you have the equity markets just about close to those record high levels, and what we are seeing in terms of course, the yields as well. Are you advising that right now is a good time for investors to put their money in arbitrage funds?
See, for that matter, any time is a good time to put your money in liquid fund or arbitrage fund. An arbitrage fund is an alternative, which is a very good alternative of liquid fund. Right now, you can park your money, which you probably need in next 6 months. Just for example, you feel that right now market valuation is too high and you cannot invest lump sum in direct equities right now. You can park that money for the time being in arbitrage fund, and whenever opportunity can come, you can directly shift it to your desired equity fund in a very simple manner.
Okay, all right. So even if let's say someone has, okay, so considering the fact that you're saying 4-5 months, just to reiterate, this is not the place where people should park their emergency funds. Is that right? Because an emergency fund, of course, is just parked and kept there. So is this the place that you could also put your money in as your emergency funds in?
See, at times we can use it, but I feel let us keep it very simple, because in investment, there is one saying that the simpler we keep it, easier it is for us. So I feel that the emergency fund, you can easily park it in your liquid fund account or maybe in your FD, and balance amount, tactical amount, or maybe some some extra amount which you need in next 6 months to 1 year, you can park it in arbitrage.
All right. So we've got that, how you can park your money if you've got extra funds, and if you want to keep it safe right now for 4 to 6 months, an arbitrage fund serves that purpose and that purpose alone. Plus, let's not forget that it's got good tax advantage as well. Excuse me, compared to liquid funds. A liquid fund is a pure play debt fund. An arbitrage fund, of course, is a hybrid of the two. What would be your choice of arbitrage fund? Because all of them do the same thing, right? They have almost at least 65% in equities, which they are hedging in the derivative market, buying in the cash market. They have 35% in debt. So mostly all of them perform the same act. There's not much really you can change from the scope of work that's there and that's allowed in an arbitrage fund. And it's not like a large cap or mid cap fund where the fund manager has the flexibility of going about choosing the equities of his or her choice, putting the principles of equity selection. So how would you choose an arbitrage fund from all the fund houses that offer it?
See, firstly, while choosing an arbitrage fund, we have to specifically look at the AUM of that fund. If the AUM is stable and it is above 5,000 crore, it is a plus thing for us. If you want the name, two of such funds can be the Tata Arbitrage Fund, which is right now a very aggressive fund comparatively. And if you want a comparatively defensive fund, you can choose Kotak Equity Arbitrage Fund. They have over 24,000 crores corpus. So these two funds can be a good alternative.
In fact, incidentally, we'll also be speaking with the fund manager of the Tata Arbitrage Mutual Fund. So, I'll advise our viewers, stay tuned for that conversation too. It'll give you a holistic take on arbitrage funds in general. All right. Well, I think we'll take on board some questions and queries that we've received. Let me remind all of our viewers that you can connect with us by writing in on our email address, which is themoneyshow@etnow.tv. Send in your questions and we'll take them up with our experts. Well, let's take on board our first question. It's coming in from Dr. Radhakrishnan. Dr. Radhakrishnan says, I'm a 56-year-old salaried employee. I'll be retiring from government service at 62. But since I am a doctor, I can practice after that. Kindly let me know if I will benefit from joining NPS at this age in light of the new changes in the NPS rules. All right, so just to, remind our viewers as well that now the NPS option has opened for those individuals who are above 65 and they can take a certain equity exposure as well for that. So Anant, what's your recommendation? Is NPS a good option for 56-year-old Dr. Radhakrishnan?
See, allocating some amount to NPS is absolutely okay, especially looking at his age, because he'll be retiring and attaining an age of 60 years in next 4 years. So he can surely invest some amount. Just make sure that if it's possible, he can keep the amount less than 2 lakhs so that he can redeem all the amount at an age of 60. So this is an added advantage which he can have, that he can invest some amount, get taxation benefit, plus he can redeem all the amount as well. So this thing he can take care of and he can invest some amount.
But of course, at 56, just a follow-up question over there. At 56, should he be, is NPS the only option available to him? What are the other instruments that he can put in his kitty, considering the fact that after 62, his income will start fluctuating, as opposed to when he's an employee, when you have that steady flow of income coming in every month?
See, in NPS, we are as such only putting maximum of 50,000 rupees per annum. So that is not a big corpus. For balance amount, he should always have a proper asset allocation portfolio with a combination of debt funds, liquid funds, or maybe arbitrage fund and equity funds. That combination can help him and he can manage that way.
All right. Okay. That's of course the view coming in for Dr. Radhakrishna's query. Okay, Shashikanta S writes in saying that, he's from Kasargod in Kerala. He's 30 years old. He has a 30,000 rupee salary per month. Now, by the time he retires, he wants to have a corpus of 1 crore rupees of a total sum. He asks, where should he invest? Now, I think this is a question, Anand, that we get very often, that they want to accumulate a sum of 1 crore rupees by a certain age. Now, by retirement, he wants to have 1 crore rupees, but his retirement is at least 30 to 35 years away. Will 1 crore A suffice? And B, according to you, what should be the amount? What should he consider when he decides what his corpus should be 30, 35 years later? And of course, where do you recommend Shashikanta kickstart his investment journey?
See, firstly, if we talk about the goal of 1 crore, and if he is wanting a corpus of 1 crore after maybe around 30 years at an expected rate of return of 11%, just 3,600 rupees per month, if he is saving and investing in equity mutual funds with an expected return of 11%, he will reach his corpus very easily. Is it sufficient or not? I feel looking at the inflation which we have right now, it is not sufficient and he will have to probably increase some allocation to it. Best way to start is at least start off with some amount, having some SIPs in equity mutual funds, slowly understand the market volatility, because see, market will be volatile, corrections will come, correction is temporary, growth is permanent, is easier said than actually applied in our portfolio. So the best thing to do for him is to start his investing. He can start with small amount, maybe around 3,600, which will suffice his 1 crore corpus. So he will have in mind that at least I'll be having 1 crore. His aim should be to at least allocate maybe around 10 to 15,000 per month for his retirement goal, so that he can have a lavish retired life, and he can save it also, because he's earning around 30,000 rupees. So he can save around 30%, which is okay. So this should be his end goal. But first goal should be to start off. Starting is the most difficult part. He can start off with 3,600 rupees per month in a good multi-cap mutual fund, stable multi-cap mutual fund, and let it grow.
All right. Well, yeah, I think starting is of course a crucial point for everybody, and yeah, I would highly recommend that you also meet a personal finance advisor, so that there is an idea of how you can kickstart your investment journey, because right now you're earning 30,000. As your income increases, your lifestyle expenses will as well increase. So by the time you reach retirement, right now you may think that okay, I'm enough spending 10-15,000 per month, but by the time you reach retirement, your living expenses will increase, your personal lifestyle expense will increase, and also of course external pressures, because we know what inflation is doing, right? A simple example is petrol. So yeah, you need to ensure that you are prepared for that too. Okay, Kishore Kumar writes in that I've invested in the SBI corporate bond fund a year back. Its return is around 8%. Shall I hold? I'm a long-term investor. I would like to accumulate wealth, but without much risk. So his own personal risk appetite or proclivity to take on risk is not much, and I think that explains why he's put money in SBI corporate bond fund. What's your take on corporate bond funds as a category, and specifically what he has invested in SBI corporate bond fund?
See, corporate bond is a comparatively very stable category to invest in, and he should hold on his investment for at least 3 years so that he can have indexation benefit. But going forward, he has to also remember that in last 1 year he has seen 8% return. In next 2 years he cannot expect 8% return, because the YTM of SBI corporate bond fund right now is 4.53%. Modified duration is somewhere around 1.69 to 70%. So he can expect returns of around 3.5 to 4% at max for next 2 years. And yes, obviously he will be getting indexation benefit, and corporate bond as a category is a very safe category. SBI corporate bond as a fund is also a very defensive and a very safe fund. So I don't think safety wise there is any issue right now.
All right. Well, we have time for one more question. So Krishnan CP writes in saying, I'm 53 years old and have been investing in equity MFs through the SIP route for a long time now. As I near my retirement, should I slowly start shifting my SIPs from equity MFs to other mutual funds like Balanced Advantage and or other debt funds? Well, he's thinking in the right direction. He is 53, so I think his retirement would be 7, 8, 9 years from now. Is this the right time to start moving away from equities, Anant, or do you think he can wait a little longer?
See, firstly, we have to do a regular review of asset allocation on an yearly basis. And he has to have around 70% in debt, or maybe around 70 to 80% in debt funds and 20 to 30% in equity funds on the date he's retiring. So when he is 2 to 3 years down the line, maybe at an age of 56 to 57, he should look at in a very deep manner, and he should start shifting. But at the same time, while shifting, he should always remember that there will always be some amount which he's saving or investing for his wealth creation. That amount he need not change it. Only the amount which he require on the date of retirement, that he should obviously shift to debt funds. Maybe 2 years, 3 years down the line, he should start doing it in a gradual manner. Right now, he can wait for it. He still have 7 years, which is good enough time. Right now, he can wait. 2 years, 3 years down the line, he can start slowly shifting it to debt funds. But at the same time, fund which is there for his wealth creation, he should not touch it just because he's retiring.
Okay, well, I think that's all the time we had to take on board questions and queries. Anand, we leave it at that. Thanks so much for joining us today on The Money Show. Really appreciate you giving us your time. And for all of our viewers, if we've not been able to take up your question, don't fret. We'll be back same time tomorrow. So keep shooting in those emails. Let me remind our viewers once again, the email address is themoneyshow@etnow.tv. And with that, we're going to take a very short break. But as promised, we will be catching up with the fund manager of the one of the funds that Anant recommended. That's the Tata Arbitrage Fund. So if you're interested in this category, or if you're already a unit holder of Tata Arbitrage Fund, stay tuned. A conversation with Sailesh, who's the fund manager of this fund, will be lined up after this break.
In individual sectors.
What's the sense that you're getting on volume growth?
Just clarify this entire case.
What is it going to mean for the business?
What else are you looking at?
This is clearly one of the biggest deals.
Here, ET now have been getting you bit by bit.
Check this out.